Whereas if you rent your home for no more than 14 days, it's not considered for the year. It's not considered a rental property. So you can rent your home for 14 days to anyone. That's it. And you don't have to report that income. Now, the tax strategy is that if you have an S Corp or a partnership, you can now rent your home to your business for no more than 14 days for the year. The business gets a deduction.
That's an expense.
Yeah, it's an expense, and you do not have to report that, or you do not have to report that as taxable income. And that leads into the last bullet point with family involvement is paying kids. Like if they're doing something actually, like doing actual work.
They running videos.
like running videos.
Looking at houses.
Like looking at houses, cleaning properties, like whatever. Like they're actually you're paying them an allowance at some point anyway. Like why not get them involved?
They're right there.
They're working for you. So and the whole purpose is that you're taking income at a higher tax bracket where you are and pushing it to a lower tax bracket that they are. And either way, like the 10% that you give, like keep doing it. Like if that's in your heart, but like that's not going to help you with your taxes because the standard deduction, especially if you marry, is like almost $30,000.
So they're already giving you that.
So you're already getting that. So unless you have a whole bunch of other itemized deductions, like a couple of $1,000s in donations not going to help. So like when I tell people like donations, I'm talking about like 5 figures.
The year is winding down and this is the best opportunity for you to save on those taxes with last minute deductions. And that's why I've brought my good friend and CPA Larry Pendleton in the studio with me today. He's going to give you 5 tips how you can save the most money at the end of the year by getting those expenses out, and so you don't have to pay the IRS with the money. Is that okay?
Sounds good to me.
Let's do it. Okay, class, it's Kris Haskins with TheRealEstateRoundup.com. My mission and ministry is to raise your financial literacy through real estate investing and entrepreneurship. So as we approach the end of the year, and my favorite time with the holidays, kids, family, and cookies and all this stuff, I thought it would be wise, both of us, Larry was going to come in and just kind of give us some nuggets and 5 best ways to save on getting expenses and deductions. Larry has been a CPA for over 2 decades, and he loves helping people. He's got a huge heart. So let's get right into these deductions so you can deploy them in your business. Larry Pendleton, how you doing, brother?
How you doing, Kris? Thanks for having me.
Good to see you again.
Always a pleasure.
I'm telling you, Larry, I don't know if you know this, but you're a unique character. Your heart is huge. You're a big guy, but the way you focus, the way you think, you're thinking about the people. Where'd that come from?
I honestly don't know. I mean, I kind of try to follow the golden rule. Treat others like you want to be treated.
Okay.
So that's I prefer to live life that way as much as I can.
We're talking about possibly upbringing, your environment, your relationships, or what?
Yeah, just bringing everything up. Like I said, no reason for me to come up by myself. So if I got knowledge and wisdom to share, I feel a social responsibility to share it and bring people with me.
Thank you, brother. We need more guys like you. You know, I'm sure you no doubt meet a million people like I do.
Yep.
And we talked the other day about when did you come to the point in your life where it's not all about the money?
Right.
When you brought that up to me, I'm I'm the same way. Why is it all about everybody? Don't you transcend that one at one point in time?
It doesn't seem like it, but at some point, it's like it has to be more than that.
Yes.
Especially if no one else is up top with you, then it's like, okay, I did all this now, but I can't die with this money, and then try to leave it behind with my kids, and hopefully they do right by it, and try to do trusts and wills and all that stuff. So
that ain't gonna work. I'm so glad. Thanks for being you. All right, so we're approaching the end of the year, Larry, and you're a CPA, so you're gonna be dropping nuggets on us. These are the five major last minute things that we need to be focusing on so we can get the best tax cuts.
Awesome, yeah. Glad to always get that question every year around the same time during the holiday season. So it's not new. It's just a lot of refresher for a lot of people. But like I said, it's good to know like you still got opportunity no matter how much time is left in the year. It's just how much you're willing to invest into your tax savings.
I got it. Well, even if you know this stuff, even you and me, I mean, it's always good to be reminded from time to time, right?
Mm-hmm. Yep.
All right, so we got this stuff here. I'm gonna let you take it, brother.
I mean, first, like before we actually like dive deep into the big five, is really understanding that you have to get your books in order now. Like get your year-end profit and loss statement or income statement, whatever one people want to call it, but you gotta know your numbers. Primarily because if you're not net, if you don't have a net profit, then you may not need any tax strategy. So, because just know that any tax strategy anyone tries to sell you is going to cost you time and money. So it's like, hey, do you even have that available in order to invest? Because you could be putting yourself in more debt or behind the eight ball by just trying to spend money on certain tax strategies. Also, a lot of these strategies we'll talk about, when we talk about time as well, it's like, hey, you try to be a real estate professional. A lot of people watching are in real estate, but like, hey, if you're trying to use like certain tax losses against your income, then you need to be tracking your real estate professional status hours, your material participation hours, as well as your qualified business income deduction hours, so that you know you can actually qualify for certain deductions.
Oh, we're gonna get. Are you talking real high, Larry? You know, you really need.
So real estate professional status.
Are we getting to that later, or is that coming?
We'll tie it back all in later, but I just really want to get into like, hey, get the books in order first before you start trying to jump into different tax strategies.
Books in order.
And then track, like, make sure you have a time log of like what you've been doing with your business, whether in or out of real estate. You just want to make sure you have all that in place as well, because you could miss out on certain deductions if you don't qualify as a certain professional in certain arenas.
All right, I'll ask you to give us an example of that later.
Yep.
Is that cool? All right, so you got your disclosures, and if you guys want to follow along, Larry's printed out an unbelievable presentation here for you. When he showed up, it was a lot thicker than this, and we have condensed it.
And we got more condensing to do, apparently.
By the time you download it, it will probably be condensed more. But we had to make sure we keep Larry out of the clouds and down here with us common people that don't understand this stuff. Larry knows all this stuff. And
call it a holiday gift, because if you're applying them, then you're going to be saving thousands of dollars in taxes. So like that's my gift for downloading it.
You want to go over this thing here first? The tax code. Are you covering this stuff here? When to think about tax savings?
No, like so. No, yeah. I mean, cool. The aspect of like understanding tax savings and all that, and like we'll share that, but just kind of help. The main thing is the bookkeeping piece of and the time log.
Let's start getting all that. Is that number one?
No, number one is actually the S Corp election.
All right. So do we need to cover the time log stuff first at all? And do we need to stay there for a minute?
Well, no. Well, I think for the people that are there, so like if you're trying to be real estate professional status with the time log, hey, it's 750 qualifying hours and more than half your work time. What's qualifying hours? You can be a real estate agent, you can be a contractor, property manager, wholesaler. Main thing is that you're running a real property trader business. The whole goal is that if you have rental properties, you want, and we'll talk about strategies to create some tax losses from your rental properties to use against your other income, because it doesn't automatically offset one another. Okay. So having that 750 and more than half your work time tracked, so if you got full-time W-2, it's going to be tough to prove that. As well as material participation, this is where we get into the short-term rental loophole, where you have your Airbnb or VRBO, average stay 7 days or less. So it's like now we have a short-term rental. You can now don't have to have those passive loss limitations as long as you have 100 hours and more than anybody else, or you just track 500, same type of qualifying hours there.
Okay.
And then the QBI, the qualified business income deduction, is 20% off your net income. That's deducted if you can prove that you're actively involved with your business. So whether you have net income from your rentals, you got good profits from your flipping business, you now have opportunity to get some additional deductions just for saying that you're actively involved with those businesses. So material participation and real estate professional status, that's more so if you have losses for your rentals. The QBI deductions, more so if you have a net profit from your real estate, from your business in general. It doesn't have to be real estate, just your business in general.
Well, I'm curious, Larry, could you give us an example of somebody trying to get some of these deductions and they were disallowed?
Yeah. So let's say a real estate agent, for example, like full-time real estate agent, he or she obviously hits 750 hours easily in 1 year as a real estate agent, but they don't have any rental properties. So being a real estate professional without the rental properties doesn't mean anything, because you have no losses that you're trying to activate to offset your real estate agent income.
Oh, wow.
But then also, so for another good example is like me and my partner, Terrion. Terrion Khan's a Class A contractor in the area. We own properties together, but he can claim losses off of our property that I can't. He's full-time in real estate. I spend more time doing taxes and tax consulting than real estate. So even though we have equal amount of losses coming to us from the same properties, he can claim it on his taxes. I have to carry that forward because I spend more time with the tax business than I do with the real estate business.
Oh, I see. So people that are working a full-time job need to be particularly pay close attention to this is basically what I'm hearing you say.
Yeah, really the type of when you're working with your advisor, it's not just go and buy a property. It's a certain type of property that you have to buy and a certain amount of time you have to put towards that property. So if you're W-2, you are looking towards doing the short-term rentals, but do you have the bandwidth to put in 100 hours, especially, if you just bought a property now and want to convert it to a short-term rental. So this is something you got to take into consideration now and the future. So let's just kind of be mindful of.
That's deep, Larry. I know people going out there. I've heard so many horror stories of people getting coaching and training and paying for education. And then the people that are selling it to them, yeah, you can just write it off on your taxes. Right? And you're the CPA, so can you just speak to that?
Yeah, so I know people like get into all these programs or whatever, and yes, the program itself could be deductible, however much you spent on that program, but if they're telling you to go buy this, you just can't buy a property and the down payment is deductible. It's not that straightforward. Like I said, unless someone's I say you have to really vet the people who's telling you the tax information, whether or not they got CPA behind their name or a rolled agent or they call themselves a tax advisor. We're not all built the same, and especially if you're just getting your information from TikTok or social media in general, Instagram. So it's just got to be cautious when you're who you get information from, because they're trying to sell you something.
You got to be careful. All right, cool. So let's see. We got, man. So it was time logs number one, or we're going to do S Corp, the corporation number one, Larry?
So S Corp Election is number one.
All right, here we go, y'all. Follow along with you. Get to download your presentation down there. The link's going to be right below in the show notes. You can just download. Go ahead, Larry.
Yep. So for my flippers, my wholesalers, my real estate agents, if you're netting at least $50,000 a year, you really need to start taking a closer look of if an S Corp election makes sense. The whole purpose is that you're still an LLC for the most part, but you're electing to be taxed as an S Corp. Why? Because if you don't have that election in place, all of your income is subject to FICA taxes or self-employment taxes, all interchangeable, but it's 15.3% on your bottom line. So if you have $100,000 a year, your minimum tax bill is going to be $15,000.
You're starting there. Before
we talk about federal and state income taxes, your minimum tax bill, if you net 100, you're going to have a $15,000 tax bill. So just know that's the whole purpose of the S Corp, is that it's going to take it from your personal tax return into another tax return.
Okay.
And instead of that 15% applied to your bottom line, it's going to be applied to the salary that you paid yourself. So if you do that, and then let's just say you made your salary $30,000, so your payroll taxes total is going to be somewhere between $4,000 or $5,000. So automatically you're going to see a $9,000 to $10,000 tax savings in that situation there.
I never forget, Larry, the day that I switched to an S Corp. It was a huge mental shift for me, because I didn't understand about my company is actually giving me a W-2. I mean, it was a leap for me. I don't know about the rest of my Roundup family, but that's a whole big. Well, I thought it was a big thought process, because you just think about making money.
Yeah, which is important, because let's say once again, time and money is going to cost. So it's like, hey, part of the requirements that you have to pay yourself a reasonable salary. Are you going to run your payroll, or are you going to pay somebody else to run your payroll? And we're in Virginia, so Virginia doesn't have additional fees for being an S Corp. But if you're in a state like New York or Maryland, that can be easily be another $2,000-$3,000
Oh, wow.
in costs.
Just to have it.
Just to be an S Corp operating in their state.
Wow.
So
okay.
and
Thank
it
God
doesn't
for
matter
Virginia.
if you got this Wyoming, like you are operating in those states. That's what really matters, where you physically are located. So that's why I say don't let the tax tail wag the dog. Understand, like, hey, if I do this, are my tax savings going to outweigh my my additional fees?
Mm-hmm.
So and you're paying for another tax return. So like it could be $2,000 to $4,000 total of additional compliance costs per year for being an S Corp.
Yes, right. We got 2 tax returns. I just wanted, as you're talking about this, it's a leap. So if somebody, can you talk more to them? Can we put your information below where you can tell them more about whether it would be a specific fit for that particular viewer?
Yeah. Like I said, they'll have information on the printout. They can also visit the website as well. So
right, cool.
They'll have all that on the download.
All right, cool. All right, go ahead.
So yeah, that's really the big piece with the S Corp election. Just kind of knowing that, and there's an example that we kind of walked through of like, hey, we're breaking that S Corp out. I mean that business out, plopping into the personal tax the S Corp 1120S tax return. You'll get a K1 from it, but you're also gonna get a W2 as well.
All right, what's the K1 and the W2, Larry? You got to get out of the clouds now, bro. K1?
So the 1120S S Corp tax return is what's considered a pass-through entity. So it doesn't pay income taxes. It doesn't get a refund. So whatever is showing as net income and net loss is generated on a K1, which is basically a summary of the tax return.
Yeah,
if there's multiple shareholders, because if you're an S Corp, you're now a shareholder. Now you now have. If you have one, then it's all going to show up on yours. If you have multiple, it's going to have multiple K1s.
Okay.
You then take that K1, report it on your personal tax return, and that's where the tax will be applied there. Except for that 15% FICA tax. It won't be applied at that point because it's S Corp.
That is so sweet to think about that. It's so crazy. You're making the same amount of money.
Yeah.
You're just electing to pay I just pay myself as opposed to taking it as profit. I'm an employee of my own company.
Right.
That's so cool. All right. So you can do this before the end of the year, set it up for next year?
Yeah, you have to file a form 2553. You don't got to get on the weeds, but that's the form that has to be filed.
You're getting high, bro.
Yeah, there's certain late elections that you're going to be making, and then it's like setting up your payroll to have basically a year-end true-up. So that's why having the financials in order let us know, okay, does it make sense to do that?
Okay.
And then how much should be your salary?
Yeah. All right. Okay. Are we done with that one, or you want to stay there?
Yep. That's number one.
Numero uno. Okay. So think about S Corp.
Yep.
Oh, darn. That number is there. We already went over that one.
Yep. A few slides in there regarding just entity structures. All that's clear, but we'll clean that up for everybody.
So we got bonus depreciation there. Number 2.
Yep. So 100% bonus depreciation is back. So
when you say back, where did it go?
So back in 2017, when we first had 100% bonus depreciation.
That's when Trump came in the first time?
Yeah, for his first term.
Okay.
So starting in 2023, it started to sunset 20% every year. So then
sunset 20%.
So basically it reduced 20. So in 2023 was 80%, 2024 was 60%, and then it was going like 2025 was going to be 40, and 2026 was going to be the last year at 20% of bonus.
Got it.
So really, what one of the big things I know. It just got passed on July 4th. What people don't realize is that Biden was trying to get it, almost got passed in 2024 as well. It just didn't pass through Congress. So
okay.
So now we have it back. So what that basically means is that there's certain assets that just can't be written off. So such as like buying a vehicle, a business vehicle, you just can't write that off fully in year one, or you're buying a tractor for your business, or you're buying rental property for your business. This doesn't apply to flips. Depreciation doesn't apply to flip properties. We're mainly talking about things that's going to be collecting rent over time. So you just can't write that stuff off. And there's certain components of the rental property that can be applied for bonus depreciation. So we're trying to get that. So if you're buying like a vehicle or a tractor or a piece of office equipment, like you're gonna be able to write that off fully in year one. However, if you're buying real estate, it doesn't really matter how much you bought it for. You just can't write the whole thing off, even with 100% bonus. But we don't know what components are in the building because we don't know the value of those. There's no incentive for the seller to break all that stuff out. So that's where you hear about cost segregation studies, which is basically an engineering report that breaks those components out to different sectors and then applies a value to them. I think of it as I have a Big Mac analogy.
It's your next slide, y'all. Make sure you're following along. The Big Mac.
Yeah, so like if you're looking at a Big Mac, I don't know how much they cost. I think it's got $3.99 up there. But when you
eat Big Macs, by the way, like
it's been a long time. I ain't get this big by not eating Big Mac. So but it's been a while,
okay.
which is good for me.
Good.
But if you're looking at think of the Big Mac as that rental property. You gotta take that purchase price minus land value and divide it over 27 years. That's traditional depreciation.
Okay.
For rental properties, for long-term rentals. Short-term is 39-year property. Now with the cost segregation study, that's when you remember the Big Mac song?
To all beef
patties, extra sauce, lettuce, cheese, pickles. You keep singing. But that's what the cost segregation study is doing. It's basically taking that song and applying it to your property. You got windows, you got a fence, you have a pool, you have LVP flooring, or you got carpet flooring, or you got hardwood flooring.
Plumbing fixtures, light
fixtures, all that, because all those things depreciate at different rates. So like anything on the land itself, if you have a septic tank, if you have a pool, a porch, a fence, that's all 15-year property. That qualifies for bonus depreciation because it depreciates less than 20 years. On the inside, you can have appliances. I mentioned LVP flooring, carpet. Those are 5-year property. Those qualify for bonus depreciation. But if you got hardwood flooring, if you got the walls and like the plumbing fixtures, like plumbing and electrical, all that is 27-year property. So mostly between 20 and 40% of the property is going to qualify for bonus depreciation.
Wow, that's crazy.
So all this kind of depends on what's in the property and what the engineering report is calculating at that time.
So the cost segregation analysis, what you said, would break down what's available for what type of depreciation, is that what you're saying? Oh, okay. Huh.
Yep. So to actually put it towards a property, and that's kind of on the next slide, is like, hey, you bought a property for $560,000. You determined the land value was it 20, 25%? Was the land value? So that now puts the actual building component at 448. So why that's important and why that's important that I put VA there, because Virginia is one of the states that don't allow bonus depreciation.
What's bonus depreciation, Larry?
That's the part that would come with the whole cost segregation study.
They don't allow 100%
bonus depreciation. They don't allow
100%. I'm sorry.
Yeah.
I'm sorry. Okay, good.
So Virginia is one of the states that don't allow bonus depreciation. So you gotta be mindful of that, because you could have a completely different looking federal tax return than you do with your own state tax return.
Oh man!
So depending on where your viewers, like where they live at, they gotta know like what state that they're living in and know whether or not they're able to claim it.
So you could do the cost seg, and it will only apply to Fed in Virginia.
It only applies to the federal, but not Virginia. Right.
Okay, got it. All right.
So that's why
that's crazy.
Yep, that's why the calculations here are based on just federal numbers, because it does not allow it. Like Virginia's only going to allow straight line depreciation.
Okay, cool.
So like that second column of like you just did like without the straight cost seg analysis, without that, you're basically going to get a $16,000 depreciation deduction per year, which is going to equate to about almost $6,000 in tax savings if you have the 35% effective tax rate.
Okay.
But with the cost seg, and let's just say only 20% of the building basis is depreciable property, or 100% bonus depreciable property, that puts it at nearly $90,000.
Got it.
So that creates over $31,000 in tax savings.
So we can do that for the end of the year.
Yeah. So if you bought a rental property in after January 12th of 2025, then you're able to apply 100% bonus depreciation.
Or whatever year. No,
well, if you bought a property in 2024 and you want to do this, it's still only going to be 60% bonus. So it wasn't retroactively applied. It only applied to January 12, 2025 going forward.
Cool. Okay.
So it's going to be around for a while. So and also be mindful that it's only a 1 year play per property. Like you just can't do a cost. It's not going to be a $30,000 deduction
every time,
every year. So just kind of being mindful of those numbers there. So it's like
not every year.
Yeah. Right. So it's like you also got to think about it this way: the government either wants you to constantly feed into the system, basically. How do you serving the masses? If you just bought one property, you only did it once, but like, all right, you want the deduction again, you gotta buy another one. So like now you in this other hamster wheel of constantly buying to get more deductions, or buying the right type of property to get more deductions.
So the golden rule is the government wants you participating in the system.
Yes.
You got to learn. It takes years to learn that one.
Yeah. Or you're just going to pay the taxes.
Either way, you participate.
They win either way. Either you're providing the housing, which they don't want to do, or you're paying them taxes, which they want you to do. So they're going to get something from you either way. It may not be dollars all the time. So you just got to think of it that way.
Okay, cool. Are you a landlord that's not getting your monthly rent on time each and every month consistently? Or maybe you got a tenant that you just need to get out of one of your properties because they're driving.
Make it real. Are you a landlord getting trained by your tenants? Because if you are, then you need to come to our mastermind so that you can learn how to train your tenants instead of your tenants training you. Tell them, Kris, how.
That is true. So listen, there's a link somewhere below above showing you how to actually get the best tenant that you can in your property that's going to pay you and take care of the property too. So Dan and I are doing a training called the Ultimate Landlord Survival Guide. We want to help you. We want to point to you the 50 years of experience that we have putting tenants in our properties, and you can do the same.
Just tell them the link below.
The link is right below. Get signed up. We're going to call you, both of us.
Stop getting trained by your tenants.
And you train them.
There you go.
All right, number 3, family involvement, Larry.
So number 3, so we talk about family legacies and stuff all the time, but it's like, are you really getting your family involved with your business?
I need to do better with that, man.
So if your spouse per se like doesn't work or doesn't have a full-time job, okay, probably your spouse can qualify for real estate professional status and be able to use these losses from your rental property to offset other income. But you gotta get your spouse involved in order to do so. Or if it's easier for your spouse to run the short-term rental to apply that loophole, then that's where it's like whether he or she can actually get involved and actually help in that sense. All right, that goes a long way. I actually have consultations with clients where both spouses are working, but they have considered quitting their job because it's best to just, because it doesn't help them to just be making more money at their W-2s. They can scale back their lifestyle, still live happily, and then qualify for bonus depreciation or qualify for real estate professional status with one spouse at that point. Okay. So it's like you really have to assess it from that standpoint. Now I know we're in the holiday season now, so like actually putting your family members as board members, so that hey, you have your board meetings wherever you have them at, maybe over a dinner or something, and the travels become deductible at that point. And so there's the meals because you actually are involving your board with your business. Now you have to document what you talked about as a board, have minutes and so forth and so forth. So it's not about just like, hey, put some names on a piece of paper and just write off everything. Like no, like actually having detailed notes of like as if it was a traditional board.
So it's different from, let's say, people that travel out of town for business and they want to bring their family with them. Is that different than, I guess, paying them to go? I'm trying to make sure I follow you.
Well, you're because there's some boards like some companies do pay their board members, but they're actually documents board members. Here's the document and paying that becomes a business expense from that standpoint there. Now there could be taxable income to the board member, so it's not just free money to the board member. So we have to be mindful there. So, But bringing your board members with you, or when you go on your board retreats or whatever, okay, now you have more opportunity to get deductions of what you are paying for lodging, travel, all that stuff as well.
I love it.
So it's just, like I said, just doing the proper documentation. So if anyone come poking around asking questions, you're already legit ready to go.
Got it. I have to stress to my Roundup family, that's why creating content, y'all, making content. My kids can they can do consultations for me. They know about this social media stuff a lot better than I do. So they're actually they're the ones that are telling me what to do. And it just creates more of a business atmosphere where someone looks in there and they say, is he just paying his kids, or are they really? They're right there with you already, and they know more than the stuff than we do.
Right.
So content will save y'all. You got to get them make this content, y'all.
Yeah. And that leads into the last bullet point with family involvement is paying kids. Like if they're doing something actually, like doing actual work.
They running videos.
like running videos.
Looking at houses.
Like looking at houses, cleaning properties, like whatever. Like they're actually you're paying them an allowance at some point anyway. Like why not get them involved?
They're right there.
They're working for you. So and the whole purpose is that you're taking income at a higher tax bracket where you are and pushing it to a lower tax bracket that they are.
I like the way that sounds.
And then, like, say if they're under the age of 17 and they're working for just your business, like you're not required to withhold any taxes if they're working for your non S Corp business. If they're just working for your single member LLC business, so like you have that benefit there. So that if they're below the federal tax threshold or standard deduction, they don't have to file federal taxes. And they're below your respective state standard deduction, then they don't have to file state taxes.
What's Virginia?
So Virginia's like $8,000 is the Virginia standard deduction. So you can possibly have to still file, but at that point they're paying the lows and no taxes. At that point, if you're just paying them up to the $15,000 federal deduction. Now, once they hit over 17, that exemption is now over, and so you still have them on payroll as W-2. You have to withhold taxes at that point. And you may want to shift them to 1099 because they're grown and you don't want to do anything else for them. So
let them think about it.
Right. So now you're basically passing on the knowledge of the tax strategies that you're learning down to your kids, so they can start saving on taxes as well.
I got it. Thank you for that, Larry. That is cool.
So, and then also, I get this question a lot about people want to pay their grandkids or pay their nieces and nephews.
Okay.
It's just one more step that you have to do in that case, where like you just can't pay the kids directly and get those, and they get the same exemptions. Or you have to pay the parent, and the parent pays the kid. So the parent has this business of just putting their kids to work. Legitimate, watch the child labor laws. But like, hey, grandma needed some work on her rental property, got grandkids, they pay the parents $5,000, the $5,000 goes to the kids.
Hopefully to make it to the kids.
Yeah, hopefully make it to the kids. All separate bank accounts. Just keep everything electronic to show the transaction. So it's all documented easily at that point.
Y'all pay these kids, man. You paying the mom and they gone to the club. All right. So that's number 4. No, was that 4?
That's
yes.
number 3.
Number 3. Yeah. Okay.
So number 4.
Medical deduction.
Medical deduction. So if you need to buy insurance, health insurance for yourself, and you don't have a separate job that you qualify for insurance, you can write off your insurance premiums there. So being able to take care of yourself and get a deduction is key there. If you have a partnership or S Corp, and you want to set up a health reimbursement arrangement plan, HRA, you can do that as well. And now you can have an agreement of what you're allowed to get reimbursed from your business. Once again, does the business have the money to actually reimburse
Stay
you?
there for a minute. When you say does the business have the money, break that down a little bit.
Once again, kind of back to our first, before we started the top 5 or the big 5, is like, hey, like, do you have your financials in order? Like, what is your income statement or profit and loss statement is saying?
Do you even have the money to pay?
Do you even have the money to pay anything out?
Yeah.
So like just knowing your numbers and like not just like, hey, I'm just going to write this off later. Like no, you actually have to kind of show that payment going out.
Yeah.
And if the business doesn't have any money to pay out, you don't get the deduction. And when you don't need it because the business doesn't have any money. Mm-hmm. So you just got to look at it from that standpoint as well.
I get it.
So, and also Now, if you're W-2 or not W-2, it doesn't matter. Like a high deductible health savings account is also helpful to get deductions as well. So
is this getting another policy, you saying?
yeah, so it's a separate, basically HSA plan, a high deductible HSA. So I know at the time we're at open enrollment, it's about to close pretty soon. So check to see if your employer already has one. If not, you can get one for yourself personally, like similar to an IRA. Like it doesn't have to be attached to a business.
Got it.
But then like you're able to get like over $4,000 in deductions if it's just you, or over $8,000 if you have a family HSA plan.
A high deductible. Are you saying this would be an additional policy, or just to have that period?
Yeah, it'd be additional policy, so a separate high deductible.
Okay, cool. On
HSA
top of
plan,
your regular,
on top of the regular plan.
All right, I just want to make sure I'm clear.
Yep. And then just kind of a non-tax bonus here. You can actually have that self-directing HSA as well, so that you can slowly start to kind of build that up, similar to retirement accounts and doing self-directed retirement accounts. Right. You can have a self-directed HSA account. Just make sure you got the right custodian that can help set you up with that.
Self-directed HSA.
Yep.
That's amazing, brother. You could do wholesaling inside of that. We talked about wholesaling earlier. Have you seen anybody do that yet, Larry?
Well, not wholesaling
inside of a self-directed, what is it, HSA?
Not wholesaling. I've seen people lend out of it. I've seen people buy, like they had enough where they can actually buy rental properties out of their HSA.
That's cool. Or rent, come in and pay your health care.
Yep. And grow your HSA that way.
That's really gangster right there, bro. That's advanced strategy.
Yep. So speaking of self-directing, our number 5 is retirement accounts. I know you talk about a lot about self-directing out of IRAs and 401ks.
That's right.
You do get the tax-free growth, but there are benefits again in tax deduction early when you get the traditional retirement accounts. Mm-hmm. So IRAs, for example, you can deduct up to $7,000 of your contributions to a traditional IRA, not a Roth, traditional. Okay. So the difference is traditional tax deduction up front, tax-free growth, but you tax on the back end.
So traditional, you're almost doing you're counting that as an expense. It's almost like you're writing that off.
Yeah.
You don't pay. I'm sorry. Go say
that. It's almost like an expense, like a tax deduction per se.
It's a deduction.
Yeah, because you get the deduction for putting the money in.
Got it.
And it grows tax-free, and then when you're at your retirement year, you're taxed on the back end.
Okay, cool. Right.
Roth, there's no deduction on the front end. You still get the tax-free growth, but you're not taxed on the back end.
Got it. Y'all get that. It took me some time to unwind that and understand what's best for everybody. I mean, one fit is not best for everybody.
Yeah, because some people can't even, they make too much money to even contribute to a Roth. Mm-hmm. So now people get into the backdoor conversions and all that, and that's not really part of today's discussion. But there's different ways to kind of get money into both, and then slowly start to kind of convert traditional to Roth throughout the years, so you don't have this huge potential tax liability in the back end.
Got it. Cool. Interesting.
For business owners, solo 401k is a huge thing to take into consideration, because you have this $69,000 deduction you can potentially make. Now, what that means is that you're a business owner. You are an employee and an employer of your business. So you can make an employee contribution up to $23,000. Now, if you have a separate W-2 job and you're contributing to that 401k plan, you can only contribute $23,000 max as an employee total, like out of all your employee contributions. So I was just talking to a client earlier today about they only put $10,000 into theirs. So they can either put another $13,000 into their W-2 401k, or they can put the $13,000 to their solo 401k.
Oh, they got both.
They got both. So you have to know that. Sweet, because man. You have to max out. You can only max out. There's only one employee bucket for a 401k. It's not multiple buckets. Mm-hmm. But then on the back end, the employer portion that you can make for your business is either 20% of your self-employment income or 25% of your W-2 income that you make if you're a S corporation.
I see.
The benefit of the employer portion, like that doesn't have to happen before the end of the year. You can actually make that after the year is ended, and before you file your tax return. So you can actually get your tax return prepared, see if you still want to make that contribution, and then make and either do so or not. So you have a choice, but the employer side. But the employee part has to be done before the end of December.
I got it. So the employer would be our S Corp or somebody's job.
Yes.
Got it. That is cool. That's why I thought that, but I didn't know that for sure. So most investors that have an S Corp, their business would be making the contribution. Is it a contribution?
Yeah, so so it'll be a contribution that their S Corp would be basically them as the employer making the contribution on their behalf.
Yeah.
But their S Corp and their employee, they can then make a contribution as an employee as well.
Got it. That is so cool, man.
Yeah. And the key is solo. So you don't have any full-time employees, or you just have part-time employees. So, but if you do have employees, you now have to do more of a SEP or simplified employee pension IRA.
Okay, that's next.
Now, once again, you just gotta kind of know it has to be offered to all your employees, and it's the same employer contribution limits as well. So that 20-25% of the W-2 that's being paid out as well. So once again, do you have the numbers? Do you have the income to actually make those type of contributions? To
need the write-off.
Now, if you're netting like 6 figures a year after all deductions and have been taken into consideration, now you're looking more into a defined benefit plan.
Okay.
So that one, it depends upon your contribution limit, depends upon like your age, how much you want to contribute, the income of the business, a lot of different factors that goes into that. Because I've seen clients put $200,000+ into a defined benefit plan and actually get a deduction from it. But like I said, that's how well their business is doing. And like I said, all this other stuff didn't do enough to get their numbers down.
Man, that's a good day right there, bro.
Yeah. So be able to put money in for your future. So yeah.
Well, I think a lot of us, especially from our culture, planning for the future is not urgent because it's not loud in our minds. Well, for me, it wasn't urgent for me many years ago, but I had a mentor that told me I should do that, and I think we need more people like you talking about this, Larry. So
also keep in mind that a lot of people are still in the mode of survival.
That's challenging.
So like if you're in the mode of survival, like I can't think about then when I gotta get stuff done like now. There's something's like around the corner a lot closer. So it's like it's difficult to kind of invest in yourself in that way in the long run.
Yes.
So you almost have to like you have to meet people where they are. And like, hey, what strategies make sense for you now? And then as things get better, okay, you can then start putting stuff in for the future.
Hopefully things get better, Larry. I mean, I know I used to think I was always going to make more money when I was young. As I got older, and some years I didn't make more money.
Right.
So I'm just saying that to say, when do we know we're going to do better? I mean, it's not promised that you will do better. I was listening to Amos Williams, and he goes, man, there's nothing set in stone that this generation does better than the previous. I mean, it doesn't have to happen.
Right.
It often does not happen in our culture.
Yep. So like I say, definitely I'm real big on group economics and like
yes,
and
you're good at that too.
We're constantly in the sense of like we gotta do it ourselves, and like life is a lot easier if you're connecting with the right people. I'm not saying partner with everyone because
some people ain't worth a damn.
You do have to do some due diligence on whoever you're going to work with. But if you find the right people, like it makes things so much easier.
Let's let them know. How is it like working with me, Larry? Tell my roundup homies.
I mean, it's been good. Like I say, it's just like a mentor aspect of it as well that I've been appreciative of like sometimes you just need to kick in the ass at times, like or look at things differently. Or like I don't take anything personal. It's like, okay, cool. Like you have your way of communicating. I'm not saying that you're a jerk or anything like that. Like it's all good, but like you know when to tone it up and you know when to scale it back, which is good. But it's like it's nothing personal because I know there's love and appreciation and you want to see people grow as well behind what you say.
I do.
And it's just like, and when we talked about earlier, like sometimes people got to hear it multiple times.
That's right.
And at some point it becomes insanity if I'm just going to keep doing the same thing and not alter. So yeah, also just having an experienced pair of eyes. Because at some point, especially whoever you're investing or running a business, it gets a bit lonely at times because you don't really have a lot of people that you can actually have those type of conversations with.
Or even relate to.
Right.
Or even relate to.
That's what I say. That's why I'm grateful to have like you and my partner Terry on, because like a lot of things I gotta talk about, like I can only talk about with you two, because like no one else really understands. They just assume everything's going well. And this is it's like a duck in the pond. Like you see this part, but like there's a lot of things peddling underneath the water.
Who you gonna talk to about my therapist? Goes, I'm like, I'm talking about a $250,000 problem. She goes, sound like you complaining to me. I'm like, well, this is a real problem that I have.
Yeah.
You know, and it's like, just because you can't relate to it, not necessarily her, but some people might not be able to relate to that size of a problem, which isn't that big.
Yeah, we know people like, hey, you telling somebody else that was complaining about $8 million. and you take a step back, like man, like I wish I had that problem.
I wish I had your problem.
And then some people wish they had your problem.
So it's
like you can peel it back. It was like, okay,
it keeps going.
It keeps going.
All right, let's get this wrapped up and land the plane, my brother.
I put a bonus slide in there for everyone. Like just kind of like done everything else. What else is there? All right. Making a large contribution, charitable contribution. Now, I know people like, hey, I do my tithes and like I have nothing against church or anything. It's just
that's just one.
That's charity. just one charity. Like either way, like the 10% that you give, like keep doing it. Like if that's in your heart, but like that's not going to help you with your taxes, because the standard deduction, especially if you marry, is like almost $30,000.
So they're already giving you that.
So you're already getting that. So unless you have a whole bunch of other itemized deductions, like a couple of $1,000s in donations, not going to help. Mm-hmm. So like when I tell people like donations, I'm talking about like 5 figures, like 20,000 up. Mm-hmm. Like that's when you're going to see an actual like material change on your tax return if you're donating that amount.
Got it.
But once again, like still donate, like separate the tax benefit from the donation or the whole reason of donating. I try to put that seed in there very clear for people.
Why, Larry? Why you want to say?
Because I think people like, well, why would I donate then? It's like, because you want to donate wasn't supposed to be about the taxes.
No,
the donation is supposed to be about like what you believe in that organization, or you believe in that religion, like, or whatever. You believe in that church, like whatever. So people still try to mix in the taxes with like, should I do it or not?
Oh,
because they need that additional incentive. It was like that should not be the incentive.
That's a little backwards.
Yeah, if you're in position to give large donations, then like do so.
Do it.
Or give any donation, then do so. But like don't let the tax aspect of it impact whether you should do it or not.
It's almost icing on the cake if you're gonna do it.
Yeah, it really should just be icing on the cake.
Yeah. Okay.
Especially if it's a cause you believe in.
Augusta Rule. I heard about this thing.
Yeah. So the Augusta Rule, named after the Masters golf tournament. Whereas if you rent your home for no more than 14 days, it's not considered for the year. It's not considered a rental property. So you can rent your home for 14 days to anyone. If that's it, and you don't have to report that income. Now, the tax strategy is that if you have an S Corp or a partnership, you can now rent your home to your business for no more than 14 days for the year. The business gets a deduction.
That's an expense.
It's an expense, and you do not have to report that, or you do not have to report that as taxable income. So that's really key kicker there, because a lot of people don't really do it. So like these last few months of the year, they have their company holiday parties.
Yeah, I was getting ready to say.
They have investor events at their place. As long as it's market rate, it was like, hey, if I would have gone to a hotel conference room or an event space,
something reasonable.
Yeah, it would cost me $500 every time to go. But I'm just gonna have that here, and I have that as my market rate because I got that from a quote from somebody else. And okay, well, I'm gonna charge that to my company.
Sweet.
So now that $500 example becomes a $7,000 deduction on your business tax return.
I like that, Larry. Thank you for that one.
Yep.
Augusta Rule. Y'all look into that one.
Yep. Solar credit. So with the One Big Beautiful Bill passed in July, a lot of the energy efficient tax credits started to phase out. So like the EV electric vehicle credits that phased out in September, and so solar panels are phasing out at the end of this year. So it's the last year of it. So if you want to get solar panels for your personal home, you can still get a 30% tax credit if you get that before the end of the year.
They're not going to renew that?
No, they're not going to renew that.
That's terrible. So why do you think the power structure doesn't want to help with solar?
They believe that it's because it's been a while. They feel like it's the credits for that has been around for quite some time, and I mean those in power now feel like they haven't got the return on the investment of providing that credit per se.
Oh, okay.
Now, if you get a solar panel for your rental property, you can still, once again, we're talking about bonus depreciation off of that piece of equipment and be able to write that off fully. So you don't get the credit per se, but you still get the deduction from a business side. But the personal side, you can qualify for that 30% tax credit.
Okay, cool.
Oil and gas funds. So since the 100% bonus came back, like oil and gas funds became very popular then. Again, because you get this aspect of I can put money into this fund. They're going to buy all this oil drilling equipment that qualifies for bonus. They're going to write all that off. They're going to give me a K-1 with a loss that I can use on my tax return, and I wasn't actively involved at all. Unlike rental real estate, you got to be somewhat involved to get some deductions. Whereas in the oil and gas industry, you don't, because the government incentivizes people like investing into oil and gas.
Got it.
And that's been around for a very long time. So that's a huge deduction that people can get if you can. And once again, vet the operator. Like just because they gave you a big loss doesn't mean anything. They don't return back any money.
That's
to
what I'm
you.
saying. The loss is for now, but you want to make. You
want them
later,
eventually
right?
start making some money. Same thing in rental property. Yeah, you get this loss now, Larry. But you have to start, like, eventually that probably has to start making some money for you.
Well, all right. Make sure we should start it out with that. You don't want to lose money every year.
Yeah, that's why, like in the like page 3 of the slides, 'cause I know there's a disclaimer in there. It's all informational purposes. Like I tell people when we talk about tax savings, understand to not let the tax tail wag the dog.
Okay. From
an investment standpoint, and everything. Like at the end of the day, the goal is to make money.
That's right. And pay taxes too. I mean, you had to pay something.
You're going to pay something. Like you really just want to, like, really your fair share is once you have leveraged all the strategies and you still have money left, okay, that's your fair share that you're paying taxes on.
It's our duty, our obligation to pay as little as possible.
Right. Like they wouldn't put all this stuff in the code if they wanted to pay, like, if every dollar was going to be taxed.
Okay. All right.
And then last and not least, like after everything's considered, after everything's been written off, then you want to make an estimated tax payment for the year end to mitigate any penalties and interest on the back end. But that's just a very, very, the well has run dry all the strategies, and that's the only thing that's left at this moment is just to kind of mitigate.
Just write them a check.
Just write them a check at that point. So. But most of these, like I say, if you're covering all of these, is probably very little percentage-wise.
It's crazy, Larry. The older I get, I'm like, man, taxes have been my biggest expense. They've been my biggest expense, Larry. Is that usually for most entrepreneurs?
Yeah, mostly it is going to be taxes.
6 figures in taxes.
Yeah, that aspect of could you busy running a business and you're holding funds to reinvest. But the aspect of reinvesting in the business in the way that actually becomes deduction, like, doesn't really cross a lot of business owners' minds. So being true to, like, hey, like, how can I put money back into the business that's going to help my business grow, as well as get the deductions as well.
It's challenging, man. You know, payroll, and I think payroll is another hurdle that I had to really get over. I'm like, every month, I gotta write a check to the IRS. They expect me to. I'm just imagining somebody that has 10 employees. They're almost knighting the business owners to be the collectors of the taxes for the government. You have to collect, like, you have to pay that to the government on the behalf of the employee.
Yeah.
I mean, how?
So in a way, like I say, you almost create additional jobs. You got to create a whole payroll department now, or someone to do that piece, or someone.
That's a whole nother expense.
So that's something to consider there. So it's the bandwidth of the IRS to, like, track all of that. Was okay. Well, we'll put this on.
They put it on us.
On the actual business owner, on the employer.
Does it
themselves.
not seem fair to you, Larry, or do you just don't think about it though?
fair, unfair at times is like is irrelevant, to be honest.
You don't even think about it. You're so up there. You're like.
I mean, because especially like say it's stuff that's been around for the longest per se. It's no different than when it comes to like tracking your expenses and like the burden of proof is on you.
Yeah.
Like when like, hey, like if they come and audit you, like you have to prove to them, like they can just come and audit you. Like they have no evidence to say you did anything wrong. So you have to provide everything when they ask.
I've been there, man. And you know what? Every time I've been audited, Larry, if you show them all the stuff, they don't even care. Like, did you do it? Here you go. Boom. Okay.
Yeah, that's the main thing. They just want to see if they can catch someone who doesn't have their ducks in order. Mm-hmm. So that's why I like having proper documentation, work with the right people to know what you need to have in place. Goes a long way.
Every time I spend something, I always say, "Is the IRS going to look at me for this? And can I prove? This is what this was for?" That's just me personally.
Yeah.
Can I prove that this was something? And I'm like, it's real easy if you're doing a bunch of real estate, you're making content, you got a business. As long as you're active and you're doing stuff and you're tracking it, I don't have a problem with it, man. I don't.
There you go.
All right, it's been an honor hanging out with you, brother Larry. I hope you have a great holiday. And people, they can get in touch with you. All Larry's information below. Download his gift to you so you can go out there and deploy some of these strategies.
Yes, sir.
All right. Anything else we want to leave for the people?
No, I mean, just make sure this is a team sport. Like, especially building passive income and saving on taxes. Like, no one's doing this by themselves. So,
nope.
Like, I know people want to try to like Google stuff and chat GPT it, but at some point, like, you have to have the right team around you to get this stuff done properly.
Yep. I have to pay them to take the payroll. I'm like, just take, because I won't write the check. Like, who wants to write a check to the IRS for X amount of dollars every month? I don't know anybody.
There you go.
So
yeah, not too many.
We just pay somebody. All right. Y'all make sure you please share this information with other people so they can get these tax savings for the end of the year, these last minute things that Larry just dropped on us. Like the content, and we'll see you on the next video. All right. Peace.